There might just be some life left in the cannabis sector after all. Simply Solventless this week reported their third quarter financial results, and while the equity might be down following the release, there's still a small army of retail investors talking about them. And considering the dire state of the cannabis stock sector, we call that a win. We're going back to our roots for this one, folks. We're talking earnings, we're talking Simply Solventless. Let's dive in. All right, let's start with the high level. For the third quarter, Simply Solventless posted top-line revenue of $7.2 million, a 70% improvement on a sequential basis, and a beat over the $7 million guidance figure provided by the company in September for the third quarter. The figure also represents a 385% year-over-year increase. Net revenue, meanwhile, amounted to $4.9 million, a 71% sequential improvement over the $2.9 million recorded in Q2, and a 287% jump year-over-year. Gross margins totaled $2 million versus $1.7 million in the second quarter, a 14% improvement. Year over year, margins improved from $500,000 in Q3 of 2023. After selling general and administrative expenses along with share-based compensation and restructuring costs, the company posted income from operations of $500,000, leading to net income of $400,000, or 1 cent per share, making it an anomaly within the Canadian cannabis sector. The figure compares to a net income of $100,000 or 0 cents a share in Q3 of 2023. Simply Solventless also reports on a metric that they call normalized net income, which is said to calculate income less the sale of a facility and settlement payments, plus the acquisition of Dash Capital Corp and share compensation expense. This metric came in at $923,000 versus to $891,000 in the second quarter, with the figure improving 4% on a sequential basis. This figure also met guidance, which was set at $900,000. Finally, adjusted EBITDA totaled $1 million, an improvement versus $952,000 in the second quarter and versus $270,000 in the third quarter of 2023, and just barely meeting the previously provided guidance of $1 million. Simply Solventless ended the third quarter with $500,000 in cash and cash equivalents versus $100,000 as of the end of the second quarter. Working capital, meanwhile, advanced from $5.9 million to $11.6. The dramatic improvement in financial results on a quarter-over-quarter basis is rooted in the $2.5 million acquisition of CanMart Inc., which Simply announced back in late June. The purchase included all of CanMart's provincial product licenses, IP, which included 2 cannabis brands, facility equipment, and Health Canada licenses. The purchase price is said to have represented just 0.18x the estimated 12-month forward gross revenue of CanMart, with Simply Solventless estimating $20 million in annual gross revenues from the operation. Well, the transaction officially closed in September. A services agreement was in place for the interim period, which enabled Simply to book 90% of the revenue of CanMart as its own during the timeframe, leading to the 70% improvement in top-line revenues on a sequential basis. But CanMart was just one piece of the puzzle. At the end of the third quarter, Simply announced another acquisition, this time targeting ANC, a privately owned profitable licensed producer that is focused on the production and sale of infused pre-rolls. The acquisition, which closed in October, saw Simply pay $10 million, of which $7 million was in the form of cash and $3 million was in the form of shares at 50 cents per unit. Earnout provisions can add up to $3.5 million to the final price paid, which is based on certain EBITDA targets being met. ANC at the time of acquisition was generating $15 million in annualized revenue, leading to net income of $3.6 million a year. With the closing of the purchase of ANC, Simply is guiding that they will exit 2024 with $10 million in annual normalized net income and earnings per share of 9 cents. So how did investors react to the record quarter? Well, they sold it down, of course, but the part we haven't mentioned is that the company also accelerated the expiry of 8 million common share purchase warrants that contain an exercise price of 40 cents a share. So yes, the equity is down about 11% following the release of the financials, but we're attributing the decline to the exercise of those warrants, not the results. As for investor sentiment, well, things are positive. Over on the CEO.ca board, multiple users were happy to see the warrants get accelerated, even if it means not all will be exercised, while others were impressed with the accuracy of the guidance. Even my old pal, Wolf of Oakville, was fairly positive on the results from a year-to-date perspective, giving it 3.5 stars on his write-up. Okay, so let's wrap it up. I've long said that one of the major things plaguing the cannabis sector is the fact that no one actually makes money in the industry, at least in Canada. Not that operators in the US are doing a whole heck of a lot better. But Simply Solventless actually appears like they might be on the path of breaking that trend. Are they cash flow positive? No. Year to date, they are operationally cash flow negative to the tune of $3.4 million. But they are net income positive, and that's a start, at least in an industry plagued with capital incinerators. The challenge that lies ahead is whether they can become operating cash flow positive on a go-forward basis. That is before the sentiment runs out on their equity. All right, everybody, thanks for watching. If you want us to keep covering this story, let us know in the comments section. We are wrapping up earnings season. We're trying to figure out what people like. If there's other companies you want us to cover, let us know in the comment section. If there's stories, news releases, developments with any equities that you want us to look into, we're happy to do that. Just let us know in the comment section. Thanks for watching, everyone.